Afternoon, students. So we are back with another video. So today in this video we are going to discuss the functions of the fourth functions of Reserve Bank of India, or the fourth function of the Central Bank of India. Okay, so Reserve Bank in our case India. So as we have already discussed the previous three functions, and those functions were like the currency authority, banker to the government, bankers bank. So today we are going to focus going to discuss the another function of the central bank, and that function is the controller of money supply and credit. So you should be knowing that, children, the commercial bank create the credit, whereas the central bank control the money supply and credit. So how the central bank is controlling the credit, so that we are going to study in this function. So due to the economic fluctuation, the central bank, that is RBI, they controls the money supply. So RBI controls the money supply and control the credit in the best interest of the economy. So that would be best for the economy. In such a case, RBI control in that way the RBI controlling the money supply and it is controlling the credit. So as RBI has the sole monopoly in the currency issue, it can control the credit and supply of money. So this thing we have already discussed. So for this, the Reserve Bank of India makes use of the following methods of credit control. So there are various instruments, or there are various methods of controlling the credit. So we will discuss that method one by one. So the first method, or the first instrument of credit control that is being used by the RBI is the repo rate. It is also called repurchase rate. So repo rate is that rate at which the central bank of a country, that is Reserve Bank, RBI in case of India, lends money to the commercial bank to meet their short-term needs. Okay, children? So here basically the commercial central bank is lending money to the commercial bank for the short-term needs. So the central bank in this case advances loan against the securities or eligible bills of exchange. So this is an instrument. So using this instrument, how the credit is being controlled. So an increase in the repo rate increases the cost. Suppose there is excess money supply in the economy. So in that case, the RBI will increase the repo rate. So if that RBI is increasing the repo rate, then what will happen? So an increase in the repo rate increases the cost of borrowing from the central bank. The commercial bank, so it became costlier for the commercial bank to borrow from the central bank because the repo rate is higher. So the commercial bank also encourage. So this forces the commercial bank to increase their lending rate as well. So as the commercial bank increases their lending rate, so which discourages the borrowers from taking the loans, because now it become costlier for the borrowers to borrow from the commercial bank. So in this way, what happens is there will be no credit creation. It reduces the ability of the commercial bank to create the credit. So if then there is a increase in money supply, so in this way the money supply will come down. Suppose in a situation like where there is a decrease in the money supply, there will be decrease in the repo rate. So the central bank will reduce its repo rate as well as the commercial bank will reduce it. So the borrowers, they can borrow from the commercial bank. In this way, the commercial bank is able to create the credit. Okay, so this mechanism, you should understand this mechanism. This mechanism is very, very important. Like using this instrument, how commercial bank is central bank is controlling the credit. The another instrument is the bank rate, or also called the discount rate. So bank rate is the rate at which the central bank of a country, RBI in case of India, lends money to the commercial bank to meet their long-term needs. So repo rate and bank rate are same. The only difference is repo rate is for short-term needs, bank rate is for long-term needs. So like using this instrument, bank rate, the commercial central bank is creating credit like this. So RBI has been actively using this bank rate to control credit. So bank rate has the same effect as that of repo rate. An increase in the bank rate increases the cost of borrowing from the central bank, which leads to increase in the lending rates by commercial bank. So it discourages the borrowers from taking loan, which reduces the ability of the commercial bank to create the credit. So when there is excess money supply, the bank rate will increase. When there is decrease in money supply, the bank rate will increase. Okay. So when there is excess money supply, bank rate will decrease. When there is a decrease in money supply, the bank rate will decrease. So when there is a decrease in the money supply, the central bank will reduce the bank rate. So it becomes cheaper for the commercial bank to take the loan from the central bank. So in this way what happens is like the commercial bank will lower its rate, so public can borrow from the commercial bank. Okay, so another instrument is the reverse repo rate. So this is exact opposite of repo rate. So reverse repo rate is the rate at which the Reserve Bank of India, RBI, borrows money from the commercial bank. So when RBI is borrowing money from the commercial bank, then it is called reverse repo rate. Okay, so RBI makes use of this reverse repo rate when it feels that there is excess money supply in the economy. So banks are always, because banks, the commercial banks, they are always happy to lend money to the RBI, as their money will be in the safer hand, isn't it, with a good interest rate. So whenever there is excess money supply in the economy, there will be increase in the repo rate, so which induces the bank to transfer more fund to the RBI rather than giving it to the borrower. So in this way there will be money supply will decrease, and when there is a decrease in money supply, the repo rate will decrease, so that instead of giving loan to the RBI, the commercial bank will be encouraged to give loans to the public, the borrowers. So in this way, using this instrument, the credit will be controlled like this. Another instrument is the open market operation. So the open market operation refers to the buying and selling of the government securities by the central bank from or to the public and commercial bank. So commercial bank, if central bank is either selling security or buying to the public or to the commercial bank, or from the public, or buying from the public or from the commercial bank. So when there is excess money supply in the economy, central bank will sell its security. So once the central bank is selling its security, then that will reduces the reserve of the commercial bank. It adversely affects the bank's ability to create the credit, and therefore the money supply will decrease. So in case of excess money supply, there will be sale of securities. In case of decrease in the money supply, there will be purchase of security. When the security is being purchased by the central bank, it increases the reserves and raises the ability of the bank to give the credit. So when increase in money supply, there will be sale of security. With decrease in money supply, there will be purchase of securities. So this is the open market operation. Another is the legal reserve requirement. So this you all know that LRR. So according to the reserve requirement, commercial banks are obliged to maintain certain reserve, isn't it? So it is very quick and direct method for controlling the credit creating power of the commercial bank. So these commercial banks are required to maintain reserve on two accounts. One is the CRR. As you all know that CRR, what is CRR? It refers to the minimum percentage of net demand and time liabilities. Time liabilities mean the deposit to be kept by the commercial bank with the central bank. So the reserve that the commercial bank, they have to maintain it with the central bank, that is RBI. It's called the CRR. So a change in CRR affects the ability of the commercial bank to create the credit. For instance, when there is excess money supply in the economy, there will be rise in CRR. So when there is a rise in CRR, then the banks have to keep more reserve with the RBI. So it reduces the reserves of the commercial bank and limits them from offering credit to the borrowers. So in this way, there will be decrease in money supply. And where is decrease in money supply, there will be decrease in CRR. Okay, so this is CRR. Another is statutory liquidity ratio, SLR. So SLR and LRR are same, but LRR is out of the total deposit. SLR is a deposit which the commercial bank, they have to maintain, but this deposit is in the form of gold, securities, etc. Okay, so SLR, it is a minimum percentage of net time and time liabilities, which net demand and time liabilities, which commercial banks are required to maintain with themselves. Okay, so they will maintain it with themselves. So an increase in SLR, when there is excess money supply in the economy, SLR will increase. So when SLR increases, the banks are required to keep more reserves with them, so it reduces the bank's ability to give credit. And when there is decrease in money supply, there will be decrease in the SLR, so that commercial bank will keep some reserve, less reserve, and they can lend more to the borrower. So in this way, using this LR, legal reserve requirements, the central bank is controlling the credit like this. Okay, another is the margin requirement. So what is this? This is another instrument. So margin is the difference between the amount of loan and the market value of the security offered by the borrowers against the loan. So it is a difference between the amount of loan and the market value that is being offered by the borrower against the loan. So if the margin fixed by the central bank is 40%, then the commercial bank is allowed to give loan only up to 60% of the value of the security. Okay, so whatever security they have given, if margin requirement is 40%, then the commercial bank are required to give the loan up to only 60% of the value of the security. So by changing this margin requirement, the Reserve Bank can alter the amount of loan made securities by the bank. Suppose when there is an increase, when there is excess money supply in the economy, there will be increase in the margin requirement. So when there is an increase in margin requirement, means more percentage against the security they have to keep as a reserve, and they are able to they give loan to less percentage of loan they can give. So when there is a decrease in money supply, the margin requirement will decrease. Okay, so a fall in the margin require encourage the people to borrow. When there is a fall in there is a decrease in money supply, the margin requirement will decrease so that people can borrow. Borrowers are encouraged to borrow from the RBI. So RBI may prescribe different margin for different types of borrower against the security of the same commodity. So margin is necessary because if a bank gives a loan equal to the full value of security, then the bank will suffer a loss in case of fall in the price of security. So it will be like doesn't give the full value of security. When the bank doesn't give loan equal to the full value of the capacity, full value of the security that is being offered by the borrower. Okay, because in that case the bank will suffer a loss in case of fall in the price of the security. When whatever security, you can call it collateral, the borrower has given. Okay, so this is the another instrument. So we have altogether discussed the six instrument, isn't it? They are repo rate, bank rate, reverse repo rate, open market operation, CRR, SLR, and CRR, SLR1, LRR. It comes under LRR, and another is the margin requirement. So there are altogether 6, isn't it? Repo rate, bank rate, reverse repo rate, OMO, LRR, and the margin requirement. So there are altogether 6 requirements, 6 instrument of the money supply. Using that instrument or using that tools, you can call it the central bank is controlling the credit or controlling the money supply in this following way. So you should know the mechanism. Okay children, the mechanism, like how. So like you will get question like this, like using the bank rate, discuss how the central bank is controlling the credit. So in that case you need to write up the mechanism. Okay, so what mechanism is there. Okay, so using repo rate, how the central bank is controlling the credit as well as controlling the money supply.